Top Hat plans are a special type of non-qualified deferred compensation plans that allow CEOs and other top executives to defer unlimited amounts of compensation and pay the taxes later. Unlike regular retirement plans like 401(k)s, which have annual contribution limits and are subject to non-discrimination testing, Top Hat plans are exempt from most of the requirements of ERISA, a law that regulates employee benefit plans. This means that Top Hat plans can be designed to favor the most highly paid employees and offer them more flexibility and control over their deferred income. For example, Top Hat plans can allow participants to choose how their deferred income is invested, when they want to receive distributions, and how they want to receive them, lump sum or annuity. Top Hat plans can also offer features such as loans, emergency withdrawals, and catch-up contributions. The main advantage of Top Hat plans is that they enable CEOs and other top executives to defer taxation on their income until they receive it in the future. This allows them to benefit from tax-free compounding of investment returns and potentially lower tax rates in retirement. Top Hat plans can also help them avoid the additional 3.8% Medicare surtax on high earners and the $290,000 limit on compensation that can be taken into account for qualified retirement plan purposes. However, Top Hat plans also have some disadvantages and risks. First, Top Hat plans are unfunded, which means that the deferred income is not held in trust for the employees, but remains the property of the employer until it is paid out. This means that if the employer goes bankrupt or faces financial difficulties, the participants may lose some or all of their deferred income. Second, Top Hat plans are subject to income tax when the income is distributed, which could be at a higher rate than when it was earned. Third, Top Hat plans are not protected from creditors or lawsuits, unlike qualified retirement plans. Therefore, Top Hat plans are a powerful tool for CEOs and other top executives to save billions and avoid taxes on their compensation, but they also come with some trade-offs and uncertainties. Top Hat plans are not available to most employees, who have to rely on more regulated and limited retirement plans to secure their future. Top Hat plans are a type of non-qualified deferred compensation plan that allows certain employees, usually top executives and directors, to defer a portion of their income and pay taxes later. These plans are unfunded, which means that the money is not held in a separate trust for the employees, but remains the property of the employer until the employee leaves or retires. Top Hat plans are not subject to the same rules and regulations as qualified retirement plans, such as 401(k)s, which means that they have some advantages and disadvantages for both the participants and the employers. One of the main advantages of Top Hat plans for the participants is that they can defer unlimited amounts of income and avoid paying taxes on it until they withdraw it. This allows them to benefit from tax-free compounding of investment returns and potentially lower their tax rate in retirement. Another advantage is that Top Hat plans are flexible and customizable, allowing participants to choose how much to defer, how to invest their money, and when to receive distributions. Top Hat plans can also provide supplemental income in retirement that may not be available from other sources, such as Social Security or pension plans. However, Top Hat plans also have some disadvantages for the participants. One of them is that they are subject to the credit risk of the employer, meaning that if the employer goes bankrupt or faces financial difficulties, the participants may lose some or all of their deferred compensation. Another disadvantage is that Top Hat plans are not protected by the Employee Retirement Income Security Act, ERISA, which means that they do not have to meet certain standards of funding, vesting, participation, accrual, or fiduciary responsibility. Furthermore, Top Hat plans are subject to income tax when distributions are made, which may be higher than the tax rate at the time of deferral. Additionally, Top Hat plans may trigger a 20% penalty tax if they do not comply with certain rules under Section 409A of the Internal Revenue Code. For the employers, Top Hat plans also have some advantages and disadvantages. One of the advantages is that they can attract and retain key employees by offering them a competitive compensation package that includes deferred income and investment options. Another advantage is that they can deduct the deferred compensation as an expense when it is paid out to the participants, which reduces their taxable income. A third advantage is that they do not have to comply with many of the rules and regulations that apply to qualified retirement plans, which reduces their administrative costs and complexity. However, Top Hat plans also have some disadvantages for the employers. One of them is that they have to report the deferred compensation as a liability on their balance sheet, which may affect their credit rating and financial ratios. Another disadvantage is that they have to pay interest on the deferred compensation to the participants, which increases their expenses. A third disadvantage is that they have to follow certain reporting and disclosure requirements under ERISA and Section 409A of the Internal Revenue Code, which may expose them to legal risks and penalties if they fail to do so.